as I say, I have a saying that is predicting is very tough, especially when it is about the future. So we can predict the markets. There has been a 10% correction this year. It was the worst start of the year for many years ago. So everything you hear in the market is record since 82, record since 10, either the ups or downs. Everything is record.
Let's do this. Okay, man. I really appreciate this. I know we've been in contact on LinkedIn for quite some time. I've been a big fan of your work. Been a big fan of pretty much how you have been conveying the markets over the last 6 months. I say 6 months. I've been following your work. As I mentioned, I think you've been a real early mover on a lot of this stuff. And the topic for today is to get into a lot of the economic impact from war, as well as a fallout from the virus and from the effects from that and how it's going to impact people. Because I think people have been focusing on certain segments, that we can see some obvious segments, but I think there's other aspects beyond even, supply chain, beyond commodities, beyond oil, that would be really good to get into today, because I don't think everyone's equipped with how bad kind of war can kind of get. So firstly, thank you very much. And before we kind of get it going, can I get even a short background into what you get up to yourself? Because even myself, I still don't know everything that you get up to.
Thank you very much, and thanks for the invitation also. I'm honored to be here. I think if you like, we can start with the early moments of this crisis, world economic crisis. In my opinion, everything started at least 15 months ago. While the pandemic stopped the world, there was no solution. It was global, strange, of course, because we hadn't had nothing similar in decades, or for a century exactly, since the Spanish flu. And with all the technical advances that we have here, especially laboratories, chemicals, whatever, they didn't, it started more than 2 years ago, and the world was very surprised. And going to the economic conclusions of this, just to make it short, the pandemic cut the world's growth in a very surprising way. And well, as it faded, it seems it is fading, fortunately. The central banks, not only in the US but in Europe, thought that by helping, which I agree, the checks that you should remember, and by giving away money with almost a 0% rate. At the time, it was a good policy, but there was a moment when it's like when you find a solution, it's very good. When you get in love with that solution, it's not so good. I'm referring to the Federal Reserve, which is, in my opinion, the, they should have started almost a year ago to tighten in the middle of the feast of the stock market. But I hoped 1 year ago Mr. Jerome Powell got another term, and I think it was not the best decision. History tells, and I believe, a very similar situation. I was very young, of course, but inflation is very difficult to. It's like a treatment. If you catch it in the first stages, there's no problem. But if you wait too much, it can be a great problem. I don't want to refer to this illness in particular, but I think it's very clear. That's
And
why we have
one
tests.
one thing in just particular in there, this is something that I'm even quite unaware of. When inflation is getting aggressively worse, okay, in the US market, in the European market, is it, how do you control it in that period? Apart from when you go back retrospectively and we do kind of Monday morning quarterbacking, we say a year ago we should have done things. If you take it in now, like how can it be actually controlled? Or is it at the point whereby economies are reopening, there's this kind of a imbalance and prices are just going absolutely haywire? Is it uncontrollable, or is there that kind of element of we could take steps, but we're still have our head in the sand?
Excellent question. There's no magic. Inflation, first of all, as I told you, this is not my opinion. This has been done um, in the 80s, 40 years ago, approximately. But to get to the point, there's, as I said, there are two tools that you have to use. First of all, is real interest rates. You cannot have an 8% inflation like now with a 1%, to say a number, doesn't matter. Doesn't matter if it's a 1%, a 3%, it does not change the problem. The first thing you need is the monetary side. I was watching the Federal Reserve president of New York just a month ago, and he clearly said inflation is a monetary problem. Milton Friedman, a well-renowned economist, also believed in that. And most of all, Paul Volcker was a banker and then turned Jimmy Carter, asked him to be the chairman of the Federal Reserve Bank. When inflation was about these present numbers, 7-8%, and inflation had an overshooting till 15%, with the almost the same scenario, because it started with oil prices in the Middle East and the huge amount of money which a huge amount of money, of course, that the government printed or bought the bonds. It's the same.
Still printed.
And as he started raising rates, and inflation was 15% a year annually, he started raising rates up to 20%. Believe it or not, 20%. And it took him 3 years to get inflation back to the famous 2% that it's
That's crazy.
the other. That's unbelievable.
That's literally
And
crazy. For context, that's what I'm reading in textbooks. When I was going through
yeah,
university, it's like inflation should be controlled at 2%. And I didn't realize that it came down from 20%.
exact 20%. And the other fact is the budget deficit. This is very obvious.
Yeah.
You can't spend more than you receive or you collect in taxes. You're printing phony money. If you want to print more, you have to raise taxes or have a huge productivity, which is not the case because of the pandemic.
Yeah.
So the only way, in my opinion, to stop the inflation now is turning a global inflation is real interest rates. When I say real, interest rates have to be above the inflation rate. And the other, you have to cut costs in the government, which it seems like impossible everywhere because it's managed by politics who want to be re-elected or want to be seen as there's more money, everybody spends more. This is great, but at the long run, inflation appears.
That's crazy because it's like almost that they're just thinking so short term in terms of their term election and even the election afterwards that nobody is like pulling off the bandage and actually realizing what's happening under the hood. And I think for the normal person, they wouldn't have heard much about even like real interest and how like this is actually going to be rapidly increasing or the inflation rate actually increasing. But now, obviously, due to extreme circumstances, we have a war that's after starting, and it's obviously really, really, horrific. It's a horrible scenario to be in. But I think the pace of that acceleration into all aspects of life, because you've mentioned globalization, and we spoke about that previously, there's becoming that huge dependency that now the issue isn't contained within two countries. It's been, really moved across the entire globe instantly. So how do you think that's kind of been affecting, not necessarily even from an inflation perspective, which it also can, but what do you think has been the huge impacts that we've seen, obviously, but that are also coming down the road? Because I think the media puts blinkers on, and it's only until you chat to people like yourself that you don't really see all of the potential issues that can come.
Well, the fact is that there are, in this case, as it happened before, the oil price, which is now very high, about
$110.
exactly today, and it's basic. It's oil for energy, but I don't mean great projects. I mean for everybody. I mean, if you have an utility bill, let's say electricity or natural gas that comes every month or grows every month, you have to spend less on other things. We're talking about basics. The same happens with food. I'm I'm listening from all parts of the world recently, as far as Singapore, that the cup of coffee is 10% higher than it was 3 months ago. So you have the basic needs. America, as I say, is everybody drives a car. It's not like Europe that it's connected by trains,
Mm-hmm.
etc. But in America, the gas price it's almost like food because they use it every day, and every day they see a different price. That's psychological. If you go to the gas station and you see a different price from yesterday, you automatically feel like you're being robbed. And I have to go back to the present problem in Eastern Europe. Ukraine is the barn of the world. As Russia has the oil, Ukraine has the food. It's one of the first producers in wheat, maize. It's if I have to define it, it is a country of farmers, and it's not easy to replace either the production of one or the other country. Then comes the very difficult situation with Western Europe cutting with the economic sanctions. It's making things worse.
Mm.
I believe this this will take many years to be solved. Um, there's another thing. The Middle East has not is not in a position to produce much more oil, and if things I always see I try to see ahead. Um, there's going back. If you don't have, we have around, or they have, the Fed has around 1% interest rates, and as you said before, very well, inflation doesn't stop. Inflation keeps on growing until you do something.
Mm-hmm.
And at the present moment, nobody's using the the two
The true
very
effect.
easy tools that I mentioned before.
Yeah,
Higher
and
interest rates and cutting the budget deficit, spending less.
it's crazy because when you're looking at food shortages as well, it's a fact that when a lot of these are being produced, even from Ukraine or even other countries and being exported, because I know that Ukraine were doing a lot of exports to Africa, and they were also doing a lot of cross exports as well, exports with India around this kind of area of like basic inputs to food that I think it will only hit the kind of shelves over the next couple of months and kind of accelerate from there. But you mentioned a great example about Singapore and just the cost of a coffee increasing. It's almost as if like people weren't necessarily thinking about it, and then always focusing on oil, and it's only as time goes on because we've even seen even in China recently when they put a bit more restrictions on due to COVID, due to numbers increasing. And it's funny because the media will always look in one particular area. So they'll say that, oh, we're looking at Russia, we're looking at Russia, we're looking at Russia. And I saw an economist saying, hey guys, the numbers are still increasing for COVID. And Shenzhen last week imposed their lock-in. That's 18 million workers, supply chains of microchips, as well as many other manufactured uh, produce. Where I'm going with this is the fact that if you took a one-day horizon, that would have an impact on supply chain. Now you're looking at a vast 6, 12 month, even longer of just controlled restrictive output. Imagine how that's going to impact longer term. And it's very difficult to articulate, and we're kind of even talking in hypothesis here because it's hard to even get to that point. And it's almost as if like were sanctions even the right idea? And I suppose this is even a good question for you. Is like when I saw sanctions being imposed, I didn't necessarily understand, really what this was going to do at the very, very top level. I just saw straight away it was going to hit the medium to lower tier of an economy, because if you stop the basic imports exports, um, it doesn't exactly hit the very top around the people around that table. It's going to obviously hit the people in society more.
I totally agree. When we have both things, as I was speaking about inflation, what you say is that it's not only industrial goods we're talking about,
Hmm.
with oil, food, but with the cheap problem, we're going to the service goods. So this seems like cars factories stopping their production, everybody dreaming about EVs, electric vehicles. They say to 2030, and I say first you have to solve the present problems. Then I think it's obvious, no? First, put your attention on the present problems and then think about the future. If we think about the future and then think about the present, there's something wrong.
Yeah.
And in this technological world, I think the chip bottleneck, as you said, is first unbelievable because each country should have its own means to produce them. It's almost obvious. It's not a. It's not so bad. What they did is import them from the countries that sold them very cheap instead of building their own industries.
Mm.
So we're going back to the globalization. Um, when you mean the sanctions, it's the opposite of globalization, and we're seeing the great uh, the great fall of production in general, industrial plus services.
That's a crazy thought, because even though like it'd be good for for countries to be somewhat self-sustainable and that they can produce their own stuff. I know this would have a knock-on effect on let's say even technology products. I actually was recording a podcast last week as well with someone else on this, and let's say that the cost of creating an iPhone or a Samsung Galaxy in the US, if you were to put all the parts together, produce it in the US. And a big thing here is actually a fair, wages. I know obviously it's what's deemed a fair wage, but if you were to pay the $10 or $15 a minimum wage, then obviously the phone would end up, I think it was like the estimated cost would be between $4,000 to $6,000. Okay. So there's that element of it, which I know that's why globalization has started. It's obvious, cheap labor, that's what they exploited. They pushed that hard. That's what happened for the last 15 years. But now, if you put in these sanctions, you get to a point whereby you almost separate society and economies. So we have an area where we have NATO and Europe and some other countries that are collectively working together, even like South America, for instance, the exports of coffee as well as many other things. And then we'll have a small populace, which could be Russia and China, that are operating then, and then they'll be disconnected. So how do you think that kind of impact could potentially play out? And I know China is also something that's kind of like a Pandora box at the moment. People are hypothesizing, saying where their stances are, and it can be quite difficult to understand at any time.
Yes, there are winners also with this situation, especially the, in the food sector. You have great exporters, for example, in Brazil, and not to not to make it so long, in about the oil market in Mexico.
Mm.
I would say the whole South America is a producer of these goods, as I said before, with soybeans, uh, whatever you can imagine in the food uh, business, and they will be for them the situation is good, but the problem is that inflation is hitting them also. And what is worse, the people in general worldwide is are getting very angry with the governments,
Hmm.
because you can't talk about the pandemic anymore. You know, the pandemic story, no, not again. And our 17,000 or 17,000 kilometers or 12,000 kilometers, miles, sorry, away. They don't understand, they don't want to understand. What they see is, as I told you, inflation is like that. You go one day, you buy something, or you buy whatever, let's say to the supermarket, and you go next week, not to say the day after, you go next week and the prices have totally changed. Or you buy the same things and the bill is higher. And
Hmm.
you think, I bought the same things than last week. What is going on? And going back to the inflation process, first of all, as I told you, a dovish, or for those who don't who are in the financial market, a very light uh, interest rate policy uh, is the first thing. But what do you do now when you have been market friendly? You created a fake bull market because because investors didn't have any other place to invest. You wouldn't invest in a bond 1.5%, and I mean, your clients would be, I mean, ETFs, great funds, your clients won't be very
Won't
happy
be too
about
happy.
that.
It's funny because like the yield on an ETF of like from 2020 to 2021 was probably like 8% or even more, like 15%, um, which is absolutely crazy. Now, obviously, I know you're not timing bottoms of March 2020, but it just became like nuts. And it was funny because obviously, I'm a young guy. A lot of my friends be retail traders, if not even intermediate retail trader, which obviously means nothing at the end of the day. But it's funny is it was like, you're only making 30% a year. What are you doing? And that's why it became so detached from reality. And then there was obviously a crypto bull run as well. And then you have people that are younger or even older people, that were genuinely looking at this as saying like, oh, you're only making 30% in a yearly return. That's terrible. Um, and it just became detached. You made a great point there about like, how it's artificial. Like the economy and the market, generally have some sort of correlation. But there just wasn't, you know, and it only exasperated. I felt it was kind of funny to look back on because even if you were in August to December of 2020, you were kind of thinking at that point, economies are closed, but the market's still going up, and you're thinking, oh, it must pull back, and then you fast forward 6 months, and it's still steaming ahead. There's obviously minor corrections, whatever, but generally speaking, it was just an uphill movement. Um, and then fast forward to now, I think it's so funny because there's all these like hilarious things online where it says, inflation 7%, and you're losing money at 7% a year. Whereas if you have your money in equity markets, you're losing 7% a day, and that's what was happening for the last 2 months. So how do you even think about that? Like as the market was accelerating, it was it purely just because money was being pumped in from the Fed, or was there other factors to play?
Well, first of all, I believe that a bull market or the price of the technology companies that were the first to be, it was like the foremost, no, as we said, fear of losing the
Yeah.
trend. Um, in general, I believe that a bull stock market is not, may not, and will not generally be good for the economy in general. Why? Because people uh, have more money in their pockets or in their accounts, as I wrote a few days ago, especially as you mentioned, very good the cryptos also. For the young, I agree, it's the young generation
Mhm.
mostly, but it made every other. We have a saying when you run, buy stocks, get out, and this happened. You run, bought stocks, your friend, your the butcher, everybody was in stocks, and um, this created a false sense of being rich for these people. So we have to add the checks of the government to them, and many of them did not work. They just invested on the stock exchange. Like last year, for example, it went up, 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 up. And for example, if you think about it, the stock exchange was not the best investment. The best investment was when the pandemic, remember March to 20, you mentioned. The stock exchange, of course, had a correction, but it was 2 days a week. But you must remember when oil traded negative in negative.
Negative 30.
And as I say, nobody, I don't know, nobody, I can say nobody, but it's like, it's never regarded as an investment or what. From negative rates to $110, how much did you make?
That is
You
crazy.
can calculate it. Negative minus 32 US dollars to $100. It's impossible. You can't remember when the ships didn't know where to go. In LA, there were about 20 to 50 ships that couldn't deliver oil and of course, other goods. And I would like to come back again, if you don't mind,
Of course.
to the present. It's ridiculous. If you have an 8% inflation, and last week you raised 0.25%. As I wrote, it will take not 3 years, as Paul Volcker did. It will take 8, 10 years to stop inflation. It's the only way. If we said before it's a monetary problem, the only thing to solve it is with monetary policy. And I know they see it. I know they know, but they are market friendly. And you can be market friendly when you are in a range of inflation between 3 and 4%, and in every meeting you cut 50 basis points. The market, everybody loves you. I'm talking like a Fed chairman, Alan Greenspan. It happened. And the market would go parabolic. Everybody was happy. Everybody was expecting the next meeting of the MOMC. And he was the hero of the market. But when you have this problem and you don't address it, you're not only the hero of the market, but you are damaging the economy. And you have to be quick, you have to be fast, you have to see problems, you have information, you have to do it before everybody else thinks about it. Now, for example, Jerome Powell is not, I think each month, today he said, we missed the first quarter, but don't worry, in the last semester everything will be okay. He didn't say how.
They're just words, though. You know, that's the way it is at the end of the day. They're political words that are positioned. versus action. And you made a good point about how, like, being so market friendly, a lot of their equity was tied up in market. A lot of other people that were senators and politicians in the US were so, connected to it, that it was almost a fact that everything they were doing was supporting a market movement versus an economy movement, which is really interesting. And then when it gets to the stage now, we kind of have a scenario where it's like mean aversion. We're going back to what it should be, which is interesting. But the fact that some of these companies, because there's a lot of similarities towards the dot-com bubble for a lot of the smaller firms, and this kind of good question I have is that, like, do you think that that scenario is there? Because the only difference that I see, well, like, a tech background that I have in, is the fact that a lot of these huge firms that are operating now crazy, like you Snap going 40% of the day and pulling back drastically, they're much larger than we had ever imagined. $1 trillion companies with Apple, many that are very close to it. That, are these companies so big that there's justified price, or is the fair value much lower, and it should be and will be pulled back?
The to be the, the first thing I would say about that is that it's a dot-com bubble, absolutely. And the prices, I have to admit, the prices are set by the market. That doesn't mean, yes, that means that if somebody would pay that price, he or she believes that it's a fair price. But as we said before, if you have services problems, chips problems, we have wages are going up because you have to, if inflation is going up of food and the main things that you consume, the consumer needs are going up in a non-logical way. As I say, I have a saying that is predicting is very tough, especially when it is about the future. So we can predict the markets. There has been a 10% correction this year. It was the worst start of the year for many years ago. So everything you hear in the market is record since 82, record since 10, either the ups or downs. Everything is record. Everything is record. Inflation is record. The price is the stock exchange records, one way, the other. And now I feel the market is not as, I would say, as happy
Yeah, it's getting
as
tired.
it was this
You can
year.
see that as well. Yeah, it's a lot of it's kind of range bound as well. Sometimes, like, even when there's like, there was a small like bounce towards the end of last week and the beginning of this week, but then it just, I don't know, it gets to the stage whereby it just gets corrected and going down, and then it just kind of gets tired, and it's weaning, I think.
Well, it's an illness. The
Yeah.
inflation is an illness, and if you don't find a way, if you're not straight and say, I heard today again
Mm.
that they could make the tapering more quickly. from 0.25 basis points to 0.50 and 6 or 7 times in the year. That's a 3.5% in the best case scenario. I don't see how they. I would be. Well, I think they should be more hawkish. Give the medicine at the first months of the year. Now, as I told you before, they are 1 year. They should have done this 1 year ago, but they should say 6, 7, 1% rate hikes. No matter what the market wants, no matter where the market goes.
Yeah, and I think it's just the, as you mentioned, it was a great quote about like the uncertainty or the predictability about the future. And it's like, okay, well, if you're not doing the right things that you should have recommended to be doing a year ago, then you've literally no control over where the market can go. And that's the worst output possible. So you're trying to taper something and control something, but it's not actually working. I know we're kind of stuck for time and we'll wrap up in a couple of minutes, but I have a very interesting question that I wanted to wrap up on is when we factor in all these aspects, okay, so you have inflation going absolutely crazy, equity markets tanking, you have commodities, operating really irregular, wheat moving 40% or whatever. How do you protect your wealth in that scenario? Like, what do you do as an investor, or not necessarily even as a trader, because I know the concept is completely different, but like in that scenario whereby, as I mentioned, inflation 7 or 8%, but you're losing money in equities 7% a day. Like, where are you unprotected completely? And in that scenario, then do you just have to face these insane losses that are coming, or is there things you can do?
Well, first of all, diversify. As I always say, diversify. And when I say diversify, it's not 30, 70, 70 shares, 30 bonds. This is not diversifying at all. Diversifying today, I cannot recommend, of course, but ETFs are very interesting vehicles because you don't have to worry about the percentage of investment you have inside the instrument. And I think I was asked I was asked by a mutual friend, which would be what are you investing and why? First of all, I know it's not very popular, but gold is a very good investment, and I will explain why. Not because I like it, not because as I say, in investment, the worst thing you can do is getting in love with your investment. So, as I say, gold, history. I'm not predicting history. In 20 years ago, gold was about 400 US dollars. Now it's about 2,000 US dollars. And that's one. Traditionally, banks have placed their clients in gold in about 10%. I think it's a good time to think about that, if a little bit more would not hurt. But as I told you before, gold has, in the 20 years, has a 5 to 10% appreciation with no risk at all. So that's the case for gold. The other way to diversify is bonds, but in developing countries, which will give you around 6% sovereign. I mean sovereign. I don't like much risk as you can see, but sovereign bonds at a medium of 6%, some exposure to some stocks that you can believe in. I see that when you use a product and you're happy with that product, and you see that the price is rationally good, you can invest in that company. So I would say always 15% stocks. So I said gold, bonds, stocks, ETFs, sorry, for expanding your investments, and I would wait and see for the rest.
Yeah, I agree as well. I think it's just the fact that things are moving so fast and so rapidly. People is kind of like it's typical of Mike Tyson approach is like, oh, you have a plan and then you get smashed with all these price movements, and then people shit their pants and lose their mind at that point then, and that's when they're making irregular decisions and irrational decisions, which is quite crazy. So I still, you're dead right in terms of like, if you're still thinking long term, if you're still built in a particularly strong way, and gold is a great example, is the fact that it does have a place. It's for these exact scenarios, and it's such a nice long term play in addition to everything else.
Yes, because people think it's not. It's like getting the right moment to buy or to sell.
Yeah.
But this is a long-term investment. If you think it has always existed, it's the only investment that has always existed. And as you study these returns, that don't, of course, one year will be 10%, the other one will be 5%.
Of course.
But I think that with the inflation rate growing, again, if I was not clear, we have an 8%, almost an 8% inflation. And I would not be surprised if at the end of the year they would have 2 digits inflation. I don't know when they are going to react.
Yeah,
because it's very difficult. Sorry.
Goes past the point of no return then at that stage. It really, really goes past the point of no return.
It will be very painful, because when you have to raise rates to such a level, you will have a recession. As simple as that.
Mm-hmm.
And it's the only way to kill inflation. It's the only way.
Crazy. I'd like to say a massive thank you for your time. I really appreciate it. Hopefully you enjoyed our session as well. As I said, I've always loved and respected a lot of your work, and I think this is a very, very good podcast for people to understand what's coming, and it's going to be super, super helpful.
Thank you very much for the invitation, And well, hope to see you in the future whenever you want.
Of course, that's always part of the plan.